Now let us see what are benefits of options trading. Options can be traded with small capital. This is main reason why retailers are attracted to trade options. But trade can be taken in options only if it allows risk involved and not because they can be traded with small capital. Options can be traded for short-term income. They are very good source for short-term income as there are weekly expiries available and there are some intraday option buying opportunities as well. Options are also a tool for protection of portfolio. They were designed primarily as an insurance to protect portfolio during period of volatility. Very useful benefit of option trading is they are very versatile. There are many strategies which can be deployed and we will go in details of most of these strategies. These can be traded in different asset classes like indices, shares, currencies, commodities. Main currency is USD INR and commodity is crude oil where options are good, liquid. There are more than 180 shares where options are available and Nifty and Bank Nifty have good liquidity in options. These are main reasons which we'll look into one by one, like liquidity, leverage, protection, diversification and strategies. Let us see liquidity. What is meaning of liquidity? Liquidity means amount of money which can be used to perform a particular transaction in that asset without moving the price of asset too much, without having to wait for long time to do so. For example, if we want to sell land worth 1 crore, we will never be able to find a suitable buyer in one day. Am I right? But if we want to sell gold worth 1 crore, we can do so in big jeweler shop or multiple shops because gold has liquidity and it has fixed rate. So even if we want to sell 10,000 rupees worth gold or 10 crore rupees worth gold, this ease of transaction without delay is called as liquidity. Money keeps flowing at fast rate without hassles. In short, there has to be a buyer who is willing to immediately buy whatever we are selling, or we should find a seller if we want to buy. Another aspect of liquidity is it does not change rate of asset. For example, gold rates once quoted by jeweler will not change for that day, for that transaction, even if we want to buy or sell gold worth 10,000 rupees or worth 10 crore rupees at that moment. It may fluctuate on day-to-day basis, but for particular transaction, if the deal is finalized, it will be fixed. Why liquidity is important in trading particular asset? Suppose we want to sell 100 shares of ITC at 210 rupees and there is another buyer who is willing to buy 100 shares of ITC at 210. Our order will be executed immediately at 210. But if we want to sell 10,000 shares of ITC at 210 and there is buyer available who wants to buy 100 shares only at 210, then we can sell only 100 shares at 210 out of these 10,000. What will happen to remaining shares? There may be other buyers available at lower price like 500 shares at 209.8, 1000 shares at 209.5, 5000 shares at 209 and so on. This can be seen in the bid and ask window. Then if we try to sell at 210 10,000 quantity, it will take time till more buyers are willing to buy at 210. If we sell at market, then our selling price will go down till last share is bought and average of selling price will be less than 210. In above example, 100 shares will go at 210, then next 500 will go at 209.8, then next 1000 shares will be sold at 209.5, next 5000 shares will be sold at 209. In this way, all shares will be sold at lower and lower rates till all shares are consumed if we place a market order. But if we place a limit order, then a transaction will happen at 210, but it will take time. So time taken depends on liquidity, and if liquidity is very good, then our market order will be executed at or near 210. For this reason, liquidity is very important. It avoids slippage. Slippage means difference between highest price at which we have placed market order and lowest price at which our shares are sold or transaction is completed. In short, when liquidity is high, market order is executed very close to current market price, and when liquidity is low, market order is executed little away from current market price if order size is big. Highest liquidity is in weekly options near current market price strike in indices and current month expiry in near current market price in other assets. Lowest liquidity is in expiries away from current month. Farther the expiry, less is the liquidity. For Nifty, there are different strike price with difference of 50 points, and for Bank Nifty, there are different strikes at difference of 100 points. Highest liquidity in Bank Nifty is at 500 gap, means at 35,000, then 35,500, 36,000, 36,500, 37,000, that way. For Nifty, highest liquidity is at 100 point gaps. 50 point strikes have lesser liquidity. This is also important to understand and remember while taking trades. This concept is very important to understand. If there is no liquidity or very low liquidity, trader gets stuck in the position. One may find it extremely hard to exit the position. For this reason, even though there are multiple expiries in indices and more than 180 shares are available in FNO section, option trades must be taken only in liquid options, especially when high quantity is desired. For small quantities, it may be okay to trade in little less liquid options, but there must be some liquidity to get execution. Let's see an example of liquidity. This is 18 November instrument wise volume and turnover report. That means this Thursday's expiry. This is turnover value in crores. These are number of contracts traded, and this is total turnover in premium. Here we can see in index futures turnover value is around 32,000 crore rupees. In stock futures, turnover value is around 1,08,000 crore rupees. This is in one day, single day's turnover. In index options, we can see 1 crore 42 lakh crore rupees. This is turnover in crores. So 1 crore 42 lakh crore. This is the amount of turnover in terms of money, and this is turnover in terms of premium, means actual options price. If price of one option is 20 rupees and lot size is 50, that means total premium is 1000 rupees for that one contract. Total premium turnover in one single day is 28,138 crore rupees for index option. Imagine this is the kind of liquidity which is available in index options. For stock options, it is turnover of around 3,800 crore rupees in single day. In terms of premium, turnover of value is around 3,16,000 crore rupees. So out of total 1 crore 46 lakhs, 1 crore 42 lakh crore rupees is turnover just in index options. That is far more. Here we can see for November month, from 1st November to 18th November, highest turnover is in index options. These are values for index futures. These are values for stock futures. These are values for index options. These are values for stock options. So always it is around 1 crore 42 lakhs crore rupees, 1 crore 46 lakhs crore rupees. Minimum transaction if we see on Monday or Friday is around 35 lakhs 78,000, 39 lakhs 49,000 crore rupees, 39 lakh crore. We hear scams of 1 lakh crore and we get amused. Here we can see there is turnover of 39 lakh crore rupees on single day. This is amazing liquidity. Index option means Nifty and Bank Nifty options. In terms of turnover, we have seen it is huge. So if someone wants to buy or sell options worth 1 crore premium, it is very minute quantity and that transaction can be done with ease. Even 100 crore worth premium transaction can be done with relative ease, at it will be less than 0.4% of total premium traded on the day. Here I am not suggesting to go and buy options worth 100 crore in one day for intraday trade. What I am saying is there is so much liquidity that one can easily deploy large capital without hassle and without slippage. I have already explained that slippage means getting order executed away from current market price if market order is placed for multiple lots. From this table of NSE website, it is very clear that index options are most liquid assets among futures and options segment. And index options turnover is far larger than any other asset class. So if someone wants to do day trading, there is no problem of liquidity. If someone wants to do positional trading for holding, it is alright to have a slight less liquidity, but liquidity is must. So does anybody have any questions about liquidity? Now next point for which we trade options is leverage. Options provide huge leverage. Taking position in Nifty futures requires margin of around 1.6 lakhs per lot. Here we can see that amount. However, to buy Nifty option, just 5,000 rupees may be enough if option premium is 100 rupees. To get same effect of futures trade, one can buy 2 lots of options and it will work out similar or better than futures if trade goes in favor with just 10,000 rupees investment. So this way options provide huge leverage. Options can be bought to hedge futures position, like the example shown here. It helps in two ways. It decreases the risk, and other way is by reducing margin required. Here we can see to buy Nifty future we need 1,06,142 rupees. To buy put we need 6,142 rupees, but total premium required is 28,000. Isn't this amazing? This is decreasing the margin required, final margin required, because the risk is limited. So we get margin benefit. This way options can be bought to hedge futures position. Options are providing huge leverage, and it is a powerful tool to make money or to destroy money. Huge leverage means big power, and options have power to easily destroy 100 crore rupees in single day. If we buy options worth 100 crore on expiry day and wait for it to become zero, it will go to zero. So this is powerful tool and it is double-edged sword. One can get multi-bagger return in single day, or one can become a beggar in one day. Options should not be taken lightly. They give dynamic leverage if position is built properly. What is meaning of dynamic leverage? Well, when we get in profit zone, speed of earning profit increases, and as we go into losses, speed of losing decreases. This is because of delta effect, which I will explain later. Please don't ask questions on delta at this point. But this is a fact. Are there any questions on leverage aspect? Next reason for trading options is protection. Options can be used to protect portfolio or to protect particular position in particular share. They can be used to earn extra income when shares are not performing as expected. Options are insurance against untoward event. Though full protection is not possible, but still it is better than no protection. Maximum loss is fixed in trades which are hedged with option buying. These can be futures trades, cash trades, or option selling trades. Protection is important role of options, and they give idea of maximum loss possible beforehand, before taking a trade. Diversification is very beautiful role of options. When view is directional, trades can be taken with options. When view is non-directional or sideways, trades can be taken in options, but not in equity. There are different strategies which can be used to balance portfolio during period of volatility, to stabilize portfolio, and to make the equity curve smoother. Understanding of market conditions is essential aspect. Without understanding market conditions, nothing is possible. Finally, last reason to trade in options is option strategies. There are lot of options available in options. Those who do not understand anything except behavior of options can utilize fixed loss, fixed profit strategies, and utilize high probability as their edge. There are multiple strategies available. There are multiple adjustments possible in option trading, which we will see in coming sessions. These adjustments help to avoid losses or minimize losses when we are grossly wrong. As mentioned earlier, these option strategies are useful for sideways as well as trending markets. We will cover all these strategies once basics are completely covered. Please don't go into strategies right now. Don't ask any questions related to strategies. If you have any questions or doubts on whether you should trade in options or not, please ask now. Now let us go ahead with real thing about options and not imaginary terms. What are options actually? So option is a contract which gives right to option buyer. What kind of right it is? Well, call buyer gives right to buy particular share at particular price, which is called as strike price, by paying a premium amount beforehand. For example, suppose current market price of a particular share is 100 rupees. I wish to invest in it only if it moves above 105 and holds above it. But I see that if it goes below 95, rapid down move can come and my investment will not be good. In that case, I can buy a call of 105. Now, if fortunately there is 20% move in few days and stock stabilizes above 120 and I see more upside, my call is already in profits. But if I wish to buy stocks in my holding, In normal circumstances, I would have to buy the stock at 120 rupees. But now, as I am holding call of 105 rupees, I have right to buy my shares at 105 rupees. Person selling call has obligation to give me delivery at 105 even if current market price is 120. Similarly, put buyer also has a right, and he has a right to sell his shares, and put seller has an obligation. He has obligation to buy the shares. It is reverse of call. And how does it work out? Let us see an example. Suppose I have one lot of share X. Current market price is 100 and I expect a big fall if price goes below 95. I wish to sell my shares if it falls below 95, but I want to give it a chance for recovery. And my view is if it stabilizes above 95, then there is no big downside. So what will I do? I will buy a put of 95. This means I buy a right to sell my shares at 95 rupees per share. Now, if share price does not fall, I do not have to worry. If share price falls below 95 and goes to 75, I do not have to worry, as I have already purchased a right to sell my shares at 95. Put seller has obligation to buy shares from me at 95 even if current price of shares is 75 or even lower. So, call buyer has right to buy and put buyer has right to sell. Options are derivatives of underlying. They are derived from asset which can be equity, index, currency or commodity in Indian markets. Trading options without knowledge is very dangerous because option prices are based on many things. There are different formulas. Most commonly used formula is Black-Scholes formula. Knowing the formula is not required, but there are 5 option Greeks which affect price of options. These are theta, delta, vega, gamma and rho. Out of these 5, rho is least important of all. We will cover all these Greeks in detail in next sessions before going into strategies and adjustments. This knowledge is essential to understand how to make which type of adjustment and when to buy or sell the option. Otherwise, it may be dangerous situation which can go out of control anytime. What are the uses of options? How can we use them? Well, there are different goals which can be achieved with options. These can be for short-term income or long-term wealth. For short-term income, we can do directional trading using options. Strategies can be for uptrend when aggressive move is expected and breakouts are working on all time frame. Script is bullish, then naked option trades can be initiated. For less aggressive positive bias, bullish strategies can be utilized. I'll provide a separate cheat sheet for this section. It will be shared in group of confirmed candidates as a hard copy at their address at the end of this course. Similar approach can be taken for down move. For non-directional short-term income, there are different option strategies available. Weekly expiries or monthly expiries are very good source for this. Usually these are done when stock is expected to cool down for some time. Options can be used for long-term wealth. They can be used for purpose of protecting wealth. Covered call is one of the common strategy used. There are some more as well. Options can be used for entering script at discounted rate. Cash secured put is one strategy useful for this type. We'll cover details in strategy section. Then options strategies can be used for extra income. Shares in portfolio or mutual funds in portfolio can be pledged to get collateral margin. That collateral margin can be used to deploy in option strategies to gain extra income on mutual funds or portfolio. One needs to be aware of rules for pledging to do this. Liquid Bs are considered as cash. Some brokers also allow to pledge fixed deposits. One can check it with their brokers. 50% cash and 50% collateral margin can be deployed in F&O trade. This is an important rule to know. If cash is less than 50% of that required for particular trade, then there are some interest liabilities. Please make it clear from your broker and understand how much is interest and what are conditions for using collateral. Different brokers have different rules. They can answer this better than me. Collateral margin cannot be used to buy options. Only cash can be used to buy options. Options can be used to mimic underlying asset with less investment. One can buy a call instead of buying shares and enjoy benefit of upmove in similar way. Now let us see what important factors we need to consider while trading options. First of all, we must know what is basis of our trade. Is it based on technical analysis, fundamental analysis, news or event based, or it is based on data analysis of option chain? Is it based on FII/DII activity? Is it based on gut feeling or based on view of someone else? Like I share a view that this stock is going down, going up. Is it based on someone else's conviction? One has to have a clear view. It can be trending view or sideways view, but having a view is must. Options can be traded in same way as we trade equity if we understand how options behave. In addition, we can trade options for non-directional view when underlying is possibly non-directional. As already discussed, options are substitute to script. We use options to trade underlying. It is important to understand movement of the underlying. If we do not have any clear idea about underlying, limited loss strategies with small position size must be followed. Liquidity of options must be checked before taking any trade in options. One should not get stuck in options due to lack of liquidity. Sometimes it becomes really difficult to exit options due to lack of liquidity. Large portion of profits may get washed out in this way, or sometimes larger loss can occur if we are not able to exit options trade. Before taking any position, volatility assessment is must for that script. Volatility has big effect on option prices, which I will explain in option Greeks. Depending upon volatility and view, one needs to decide whether to be option buyer or option seller. Our portfolio worth decides whether we can take position as per risk involved, but it does not decide whether we should be option buyer or option seller. Are there any questions on this?